Hello and welcome back to the next episode of Lake Effect Investments. I believe we are on VLOG13 now, and this one is called Through the Roof, literally. And that is because our portfolio has hit its peak performance at plus 70%, literally through the roof. In fact, in fact, I had to rescale the roof several times, especially a few days in May when all of this was going on. So a couple of stocks, a couple of drivers that did this, and it was quantum, the D-Wave quantum stock that I picked up a while back, and I've been talking about it in previous vlogs. And then NVTS Semiconductor also had a very big showing because it got picked up by NVIDIA as one of its suppliers, semiconductor suppliers for the AI build out that's going on. And Akebia Therapeutics, which is Biomed, also had a very nice showing. It also doubled, plus 100%. So yeah, I had to literally rescale the roof several times. I was almost waking up every morning and the line was shooting off the charts, and I had to rescale it a couple of times. So I won't do any more jumping with joy. Okay, I've done enough of that. But so we'll talk about that definitely in this vlog as to what happened and a couple of different approaches that I took. So one of the stocks, which was D-Wave Quantum Computing, did end up selling that one and hit a nice peak on that one. But the other big one that went through the roof, which was NVTS Semiconductor, we are holding on that one despite it's seen some retraction. Naturally, it's gonna retract after it does that kind of jumping around. But yeah, so we'll talk about those two situations and why I hold one and not the other one. I'll do the regular wrap up of macroeconomic factors, stuff going on in the macro environment. So we'll do the roundup on that, and then we'll have a fun session with just a little feature that I'm going to do this time around about stock market legends and people who've been getting things wrong, pretty much all the time since I've started following this stuff pretty up close. And also a shout out to one of the folks who's been following the vlog. So Ali Chima, shout out to Ali Chima. He sent out a couple of nice questions, interesting questions, definitely. Oh goodness. So I'm gonna go there and yep. With regards to what's going on, and I think mostly around risk management or kind of what do you do now, right? What do you do? How do you protect your gains? How do you trim? How do you hold? How do you what do you do in terms of I think you use the word stress testing over here, but securing your gains versus keeping some positions open for further gains in the future, and of course the risk that that might not happen and you could lose your existing gains as well. So I'll talk about that too. But anyways, let's go and get started with the macroeconomic stuff. Okay, so the macro environment. So here's the typical box that I do, the risk box. What's on top this time round is national debt, stuff that's going on in long-term treasuries. I'll touch upon that. The big beautiful bill, right, that touched off the sparring between Messrs. Trump and Elon Musk, and all the commotion that it's causing around debt levels, national debt levels, and how that's going to bear on generally on economics and the economy, and then of course on the stock market as well. Trade wars, tariffs, the S word, stagflation, consumer sentiment, and all that. It's all baked in there, I guess. That's maybe just sitting a little bit below that. And then economic recession, market sell-off. We've been talking about that, so that's all there as well. Not much of a chance of economic recession. I should say a lower chance, or not much that's coming up in terms of some indicators pointing towards that. But it's all very mixed up. It's all very hodgepodge right now. We really don't know which way this is going to break out. And there is a couple of things which are concerning and worth keeping an eye on. But it's a little bit further down the risk matrix right now. geopolitical risk is was kind of up there, but then it kind of wasn't very quickly. So it's gone down. Had to do with that whole Middle East situation, which was kind of come and gone, especially related to Iran, and the sparring between Israel and Iran. Both these guys don't have much of a bearing on the global economy and much of the stuff that we talk about over here and what's happening with some of these growth sectors and breaking technologies. So it's definitely good that they're quieter now, and hopefully it stays that way. And then the tech AI business case is what I've been talking about in previous vlogs as well. This really has to do with how the artificial intelligence platform is going to develop and how hot it's going to be. And if all the speculation and all the optimism and euphoria around it is gonna pan out, it's gonna mean something. It's actually gonna pan out in terms of a real business case, or is it just a lot of fluff and platitude, or is it more fluff and platitude than what we think it is? So I think it's doing fine right now. There's definitely a lot that's going on. There's a lot of capital expenditure spending by the Magnificent Seven companies building out AI infrastructure. Definitely NVIDIA with its GTC conference, and I kind of watched through the entire 2-hour speech of Jensen Huang. A lot of investment going into it, a lot of text going into it. So it's definitely a low risk thing. I don't think that's going to be a problem going forward. But let's pull back and talk a little bit more about this whole national debt thing, and then maybe then a little bit about recessionary indicators and things. National debt. I've talked about this before. The national debt. Let me just share what I kind of had here before. This isn't really talked about much, but the numbers that are usually thrown around are like 37 trillion, and now with the big beautiful bill, to think that over the next 10 years it's going to go up to maybe 40 trillion or something, and we're going to start hitting those levels. And there's a lot of political grandstanding around that in terms of how real that is or that's not. And I guess the Republicans are saying that it's not going to be like that, and Democrats are saying, yeah, it's going to be pretty bad. And I guess Mr. Elon Musk wasn't too happy about it either. But over here, what I shared before is that when you look at the national debt, right, there's a lot of it is intra-government. So the federal government borrowing from Social Security, right, borrowing from state and local governments and from the Federal Reserve. This is left pocket, right pocket stuff. It's definitely not good that the federal government owes money to Social Security, which is owed to retirees and stuff. But it is left pocket, right pocket at the end of the day. It's not owed to any external entities. And when you get an emergency situation, when push comes to shove, you are going to have to make adjustments, and you're going to have to make tough calls. So maybe it's going to be retirees, which is coming up for people like me, having to work longer, having to live with less benefits, something along those lines, which, it is what it is. At this point, I don't think we can get around that. State and local governments, I guess you got to dig in and see what's already going on over there. Federal Reserve, not too sure what that's about. But again, it's left pocket, right pocket stuff. It's robbing Peter to pay Paul. So there is an adjusted level. And over here, I just took the current levels. This is 2023 data. So 2024, if it's 37, it'll be like 21.6. Of course, we don't want to go out and we don't want to flaunt these kind of numbers and encourage politicians to rack up the debt even more than what it is. Because it is, at the end of the day, problem that needs to be solved. But maybe it's not the bomb that everybody thinks it is at this point. It's not causing me any lack of sleep or anything right now. There's a lot of discussion around long-term treasuries with this, and basically what that means, a lot of the federal debt is issued through U.S. treasuries. So, if you look at the 10-year and the 30-year has been in the news quite a lot as well. They're doing okay. There was this whole Sell America conversation going on about a few months back, where China is going to start selling out of these bonds and taking that money elsewhere. because they're a big holder of U.S. debt. In fact, I've got a chart over here that I've shared before as well. Yeah. Yeah, so these numbers are going to be a little bit dated, but you can definitely see the big ones, some of the really big ones over here, right? Like Japan and China and UK. I don't think Japan and UK are really doing a whole lot, but maybe China is um, starting to sell these and tapering down its exposure to the US, and that whole decoupling thing with the US economy and the tariff sparring and all that stuff as well. So far, I mean, the treasuries have done their thing. If there's going to be a sell-off, rates are going to be higher, and I don't know, there could be liquidity issues or something like that. But so far, I don't really see anything that significant on the horizon that's going to cause us a lot of alarm. There's been a lot of discussion on the 30-year treasury because a lot of this debt is issued in long-term bonds, and it's spiked up. It's been up and down. It's broached the 5% level, which is kind of psychologically pretty significant. But again, it's been bouncing, and it's also doing okay. And if there is a situation, if interest rates do come down and there is a sell-off or something like that, the question is that where are people going to go, right? If you look at interest rates around the world, or you got to look at it in interest rates in basically major economies that can take in these kinds of volumes, and that they have the debt to issue to take these in. So it's got to be stuff like Japan, Europe, maybe Canada. China itself has a surplus, so I don't know what sense it makes that it's going to have a huge debt market. But a lot of these rates are pretty tepid, right? I mean, they're low. They're lower from the U.S. Treasury levels. So I don't know, where do they have to go? That's another question. And then if you go back to this, there's geopolitics involved in this, right? It's not just purely transactional, not purely financial transactional. There's a lot of geopolitical concerns. There's diplomacy around it. So it's not like Japan and the UK are just going to walk out of the door if interest rates go down 100 basis points. And like I said, if they're going to walk out of the door, where are they going to go? It really isn't anywhere else. So looking at some of these fundamentals and some of these facts around it, I don't really see a huge, a huge issue at the moment. But here we go. But yeah, it's big in the media. It's big in the news. And I think with this whole bill that's being debated right now, that's why it's headlining itself. But I think it's probably gonna move out, and something else is gonna take its place. Anyways, that's that. But I think the part that kind of caught my interest, with maybe a significant economic correction, maybe even a small recession coming up, or a big recession, who knows, is that one of the indicators I watch is the credit card debt levels, right? And credit card and consumer debt, but credit card kind of on the upfront, and that really has been spiking up, and it's been spiking up for quite some time. I think it's at about 1.2 trillion now, and it's been breaking records for quite some time, and that is a bit concerning because that can really hit the brakes, and it can, we can come to a screeching halt with consumer spending. Not a halt, but a significant slowdown, and that can kind of cascade into a lot of other things retracting, and something leading to a recession. It's primarily driven by consumer sentiment, and consumer sentiment, even though there's conflicting information, the most of the economic indicators have been coming up above expectations. So even if there's a retraction of the GDP, it still comes out a little bit above what the expected levels are with these reports. So I guess so far it's doing okay on some of these fronts, some of these indicators. Same thing with unemployment. But consumer sentiment index has been pretty much soured up, primarily because of all the uncertainty that's going around. So it's kind of been up and down. But this could play into something more significant. And there was an article that kind of caught my eye, which talked about a very similar situation back in 1974, I believe it is, where you had these conflicting indicators. So you had lower consumer confidence, but durable goods orders were kind of doing okay. TV sales, car sales, a lot of stuff that you look at and how people are basically thinking about spending money and how confident they feel and how okay they feel about the economy were on the positive, but the sentiment was kind of on the negative, and the market and the economy and the economists and most of the commentators kind of went with the more positive indicators before there was a very hard pullback and a pretty hard recession that came up. So this was back in 1974. So we could see something similar play out, and it's definitely worth keeping your eye on the ball with a lot of this stuff and see how these economic reports keep coming out. GDP so far, I believe, first quarter 2025 was 0.5%, so a contraction was expected. This was much lower. Actually, it's a negative decrease, right? So it's a minus 0.5%, and that's also because of a lot of the front loading of imports, right? So imports is a negative to the GDP formula, and all the front loading of imports was done basically to get around these tariffs that people think are coming up. But second quarter seems to be, at least the forecasting and the indicators that they use to forecast where it's going to land. We just finished second quarter. They think it's going to be pretty okay. So maybe around 2.9%, maybe somewhere between 2.5 and 3.5. Probably not 3.5, but maybe somewhere around the 2.5 level, which will be pretty solid as well. But yeah, it's mixed up. It's all over the place. The tariff negotiations, the 90-day thing that Trump did, going country to country, still going on. Where that's going to settle, how that's going to settle, is all up in the air at this point. And how the consumer reacts to that is also remains to be seen. So a lot still yet to come. The next 2 to 3 months are going to be pretty interesting. But sort of an end of year retraction, correction, maybe even a tepid recession or something more than that is definitely on the cards. Okay, so let's move on to the fun part, the portfolio and our hockey stick portfolio. So there it is. There's the hockey stick, and basically, couple of big movers behind this. So NVTS Semiconductor definitely had a huge play in that. They got picked up by NVIDIA as one of the suppliers of their gallium nitrate technology to power the next generation of AI data centers and other infrastructure stuff. So yeah, that was big. And then D-Wave Quantum Computing also had a very nice uptake. Just a lot of interest, consumer interest in that technology. Not consumer, investor interest. And institutional buying, as well as some key breaks. D-Wave Quantum had basically a new product launch with their next generation of, I think it was called Advantage 2. Yep. That they can incorporate with some existing systems and existing traditional computing systems and cloud computing to provide some super sharp calculation capabilities that quantum computing brings to the table for their customers. So they're working on stuff. They're actually in the game with contracts, with clients, with customers, large corporations, working on ideas. It's early. Yes, it's definitely very early stage. But there's traction there, right? And there's still a lot of speculation, but there is definitely good traction there. So they did very well on that end. And then we also had a pretty nice pickup in Akebia Therapeutics, which is chronic kidney disease drug development, biomed stuff, and that basically all added up to to this really super sharp breakout that happened kind of late April over there through May, and has held up actually pretty well, with the exception of well, I shouldn't say the exception, but basically DWF Quantum, the most speculative out of these, and I'll talk about that in a minute. I did sell that out at $19.47 after having bought it for $5.67. It was just a very high valuation point. It doesn't, despite all the optimism around the technology, it doesn't make sense to me that it is going to, these levels of valuations are sustainable. And ever since we sold it, it did retract back to around about $15, $14. So I got to go back and think about how I'm going to approach quantum computing, because this is definitely a sector that I want to be vested in for the long term. So maybe I come back into this guy at a lower level, or maybe I do something a little different. Also looking at the other guys, which is Rigetti. So here is my quantum computing portfolio. Come on. Yeah, there it is. So maybe I do a mini ETF or something like that. I'm thinking about it. So maybe, share my thoughts maybe on a future vlog or something. But it could be a combination of these guys, because it is so early in the game with this, and these guys have very different approaches to quantum computing, right? They're working on different technologies, different ways to improve it. There's problems to solve in quantum computing, and they're taking different approaches to it. So maybe one will be a big winner and maybe the others will not. Maybe they'll all win big. I don't know. So maybe take a more measured approach, and instead of putting everything into D-Wave, do something a bit more diversified. So that could be, these are all early movers, and most of them are doing, the one that I don't know too much about is quantum computing, so I'll look into that as well. But they're all seem to be doing pretty well. So yeah, we'll go back to the drawing board with this and see where that lands. But for now, D-Wave just had such a sharp uptick, almost all the way to the $20 mark, starting from $5, that it didn't make sense to, those levels of valuations didn't make sense. And also, I wanted to book some realized gains into the portfolio to secure some of the performance levels. So this was also an idea behind pushing the sell button on that one. So I think that was one of Ali Chima's questions as well. How do you think about what to hold, what to sell? So maybe we just talk about that now, right? I don't think there's a whole lot more here that I want to cover. AirDX, I'll talk about that at a later point. AirDX has been a bit of a disappointment. It's been on the on my books for a long time, and it's at minus 30%. But I'm holding on to it. I still like their overall direction and their overall fundamentals. They're caught up in, I would say, legal, systematic twists and issues with how pharmaceuticals work in the United States, and there's been legal issues around that. So I think they'll unwind out of that at some point in time, and hopefully they'll resume that. And also, I don't know if I haven't talked about the dashboard, right? But so I'll talk about the dashboard maybe now. I'll just do that now before I go and talk about NVTS and NVTS versus QBTS, hold versus sell. But here I have a dashboard, so I basically get a bit more organized around this stuff, and I have these data points handy, as well as I can do a better view, risk assessment, evaluation, and maybe I'll build a risk matrix around that, around this stuff a little later as well. But here's just some basic facts around each of the stocks, right? What's the trading volume? What's the capitalization levels? How many years they've been out there as a public company? What are the targets? What are the analysts saying, right? And what are the ratings? And so stuff like that. So everything here seems to be pretty agreeable. Even ChargePoint is the EV stock, the EV charging stock that I have. That's been on the low and low because the EV industry overall is going through some pretty hard times, and the administration is not helping. Donald Trump is not a big fan of EVs, but so be it. These trends are hopefully technologies are bigger than presidents and certain people. But this bottom 35% rank by Zacks is also not real, because they rank it against more generalized vehicle accessory manufacturers, and that's not what ChargePoint is, right? ChargePoint and EVgo and Blink Charging and these EV charging stocks are very much their own niche at this point of time, and you can't use a generalized reference point for that. It's definitely depressed, it's definitely distressed, but it's not a bottom 35% thing. And by the way, we're actually at 20% without returns, because we picked it up at 59 cents, which I should have over here. This is not correct, so I'll correct it, I guess. Yeah, let's just do it now. All right, and yeah, that too. Yeah, the 12-month target seems fine, and this is all calculating the way it is. Yeah. So we picked it up at 59 cents, and it's already at 20%. So that was another reason to go into this stock, was even given all the stress factors around it, the price point was pretty agreeable. Okay, so yeah, we got this dashboarding now going on as well, which is pretty cool. And I think now we can go on and talk about NVTS and DVF Quantum for a little bit, and let's do that with we'll lead in with Ali Chima's questions over here, because I think that all kind of ties into it. Okay. So first of all, yeah, thanks for the compliments. Beast mode, 71% over 293 days is pretty good. Clearly you saw something early most people didn't. I wish I could lay claim to that and say that I did, but somewhat true, but not entirely true. In one of my very early first vlogs, I have to keep popping this up, but I guess I'll have to. But let's go back in here. So I did talk about this research paper that I came across over the internet, talking to basically small caps valuations being at 20-year lows, right? So if you look at this time period, especially from 2022, I think, when the pandemic is kind of closing out up till now, most of the valuation gains in NASDAQ have been driven by the Magnificent Seven companies, right? So Tesla's done really well during that time. Google, Amazon, Facebook, NVIDIA especially, yeah. NVIDIA, big players. So a lot of concentration, a lot of activity in those guys. And these guys maybe have been left for dead or sidelined or, fallen off the charts, fallen off the radar and stuff with people. So the valuations had been pretty low. And that's kind of what sparked my interest, is that I didn't feel too comfortable coming into the large caps and the Magnificent Seven stocks at that point in time, because the valuations were super high, but over here the valuations were super low. So a lot of these companies, like I've mentioned, they're risky because they are small caps. They don't have a lot of wiggle room. Something goes wrong, something goes bust, the economy takes a turn for the worst. They don't have a lot of levers to pull to stay alive. So that's what kind of makes them risky. But at the same time, the price point is at a 20-year low, so your risk is kind of mitigated in that way. So kind of took that lead, and then kind of went around looking for some good technology stocks that are kind of in this position, but they still have some pretty good fundamentals that you can work around. And so as you can see in over this dashboard, All these guys were kind of in that spot at that point in time. And there I will take some credit that I think that this was a pretty decent pick. Pretty lucky as well to have these lying around sitting at those very low valuations at that point in time. And a lot of them didn't have bad fundamentals. In fact, their fundamentals had been improving, and they kind of, this happens to them. In fact, let me go to the actual, let me go to my portfolio itself. And if you take a look at the long term, so this is kind of very similar to what this paper was saying. And as far back as even 2023, their valuations are kind of 3x what they are now, which is already plus 71% from this kind of low August 24 point. So definitely they did very well. I think my lawnmower guy just showed up. But anyways, we'll just keep doing this. So yeah, so from that perspective, it was an idea that was out there that was floating in the market. But at the same time, I think doing some good fundamentals analysis to come up with some good stock picks, I'll definitely take that. But then, yeah, the long-term fundamentals mindset is pretty good, because with all the noise, like you mentioned, Ali, is that and with what Warren Buffett was saying at the time as well, that if you do come into the market at this point in time, make sure that you're prepared with the 50%, that you're prepared to sit with the 50% loss on your portfolio, and that you have the ability to sit with that into the long term until the recovery takes place. So yeah, that definitely is a benefit of long-term investing, that you may, you're not going to have with short-term investing, and also and leveraged investing as well, where you borrow to invest. All right, I don't know how this is going down on the vlog, but I'm just going to keep going with all this background noise. Okay, so what's your process from separating the can wins from the will wins? So yeah, I think I talked about this in this post, that you cannot know which companies are gonna win big. What you can really size up, what you can really assess is which ones can, right? So you can look at all these fundamentals and you can say, okay, it looks good, the valuation looks good, or maybe the valuation is at a low because the market is stressed, because the environment is stressed. So it looks like it's a good bet. But again, long term, you cannot know what any individual company is going to do. That's why people go into ETFs and index funds and mutual funds, because it's kind of more, it's market wide, right? So it'll follow more what the market does. But then again, the growth rates are not as interesting and as exciting, and you don't have to do much analysis there. I'm not too interested in doing that kind of stuff, because I've had a career as an analyst, so I'd rather do this, where I have to dig deep into these things and size them out. But yeah, you God, where was I going with this? Yeah, the can wins from the will wins. So yeah, so you cannot really truly know which one of them are going to win big. Anything can happen with any company. So for example, there's the AirDX example that I was just looking at, right? AirDX is about minus 30%. Its fundamentals look super good. It was ready to fly, and in fact, it did fly pretty well for some time before it took a bit of a nosedive, given all its legal troubles and CMS, the Center for Medicaid and Medicaid Services here in the United States, and it hit some legal troubles, and so it's been pretty erratic. But it's done very well for investors who picked it up at these price points, right? Not for us so much, because we were kind of over here. No, not over here. So August, yeah. Well, not too bad, right? But again, this is kind of what happened, and of course the attraction was over here as well, because there was a big retraction in the price itself. So anyways, point being that you cannot know what's going to happen in the course of any one company. You can watch it as much as you can. You can look for red flags. You can look for signals, and a lot of that stuff is real. That can be done. A lot of times it's going to hit you in the face, and you're not going to know in time to be able to take any kind of evasive action or take any kind of a mitigating action. But yeah, that's the thing with these stocks, is that you're pretty much looking at what can win big, and you're not gonna know too much about what will win big. So if we go to, for example, NVTS, right? Now NVTS, the entire situation is pretty different now, because they are now they're going to be a major supplier for NVIDIA Corporation. They have traction. They have a lot of design wins, is what it's called, with these AI infrastructure designs, and they have a good pipeline. Their financials and fundamentals are pretty good, so they're on track. And now there's a greater chance that they are gonna continue with that, and they're gonna hopefully end up in an even better spot. So we're here, but they've been in even better places. Of course, I think this was more driven by market euphoria and just more speculation at the time. But this stock has done even much better without its fundamentals, the kind of fundamentals that it has today. So tomorrow, when hopefully more favorable market environment returns, with maybe lower interest rates and more positive sentiment around tech stocks, it could do even better. So that's also the reason that I'm holding on to this one, despite all these gains, and risking that plus 200% or whatever that I have in this stock, because it has the fundamentals, it has the argument that it's going to continue down this path, versus DVF Quantum, which is the one that I sold, because this is just mostly speculative at this point in time, right? This move that it made, it's going to do about 23 millions in total revenue in 2024. Of course, what the market is saying is that it's going to do much better in the future, and get into it now before it's too late, before it gets out of reach and everything. But it doesn't have the kind of credentials that NVTS has right now, right? So it is going to be susceptible to more sharper retractions and more speculative losses and speculative gains at the same time, I'm sure, than something like NVTS does. So that was kind of my risk management strategy overall. With the question that you have over here, is that how do you differentiate between those two? So I think that if I had a category, maybe I should do this. Maybe I should make a bucket of the can wins and the will wins. Of course, we cannot know 100% what the will wins will do, but you have NVTS kind of more skewing on that side. Hey, this company is looking pretty good. Now they have more momentum, they have more traction, and they're with one of the prime. I think NVIDIA now is the most highly valued company in the world, right? I think they're probably at 3.5 trillion plus now. I know they've done very well. Sorry, that's NVDA. Yeah, 3.7 trillion. I think they're number one. They should be number one at this point. I think the only other company that should be close enough would be Microsoft. I know Apple's gone down a bit. So yeah, Microsoft's right there, but NVIDIA is definitely number one. So of course, NVTS is going to be more on the will win side, and DVF Quantum is going to be very much pure of a kind of can win, maybe will win, but that can all change. So you want to watch it pretty closely. You want to try and stay on top of it as much as you can, and try and size out each development in terms of what that's going to mean for its future. So that's kind of how much you can try to differentiate one between the two, right? Yeah, so that's how you handle trimming something versus holding something when you're up 101% plus. NVTS I'm going to hold because of the reasons that I just mentioned. and DWave Quantum I sold because of the reasons that I just mentioned. All right. Yeah. So how is it all gonna hold up when macro headwinds start hitting? And how do you stress test this? I think you mentioned stress testing in here somewhere. Um, yeah, that's the thing with long-term fundamentals-based investing is that you want to get over those kinds of macro trends and macro cycles when, if and when they do happen. And the key part over here, which Warren Buffett didn't mention when he was talking about 50% retraction possibility in the stock market if you're going to get into it, is basically you're holding, and call it holding power or your liquidity, right? Let's call it liquidity, the ability to hold the stocks for the long term, right? So if you're leveraged, which means you're bored to hold the stocks, that's going to compromise your ability to hold these stocks, right? Then you get into things like margin calls and all that. And if the stock takes a nosedive in the interim because the macro environment is too risky, because we've hit a recession or something, then you're going to have to liquidate to make your margin calls. So you don't want to do that. If you are investing with pure liquidity of your own, kind of like what I'm doing right now, then you also want to see that you are going to have any events or any risk against that liquidity in the future. So there shouldn't be a situation where you have to sell your stocks to cover something else, to cover your, I don't know, your mortgage or any kind of expense that you might come up with in the future, because then that can also land you into a position where you have to sell at a loss. So holding the ability to hold liquidity is basically your stress test in these scenarios, right? You got to be able to live with the stress and live out the stress and be able to come out of it. So liquidity is the key word over here. That's how you manage your stress with these. So yeah, I think that pretty much covers what I was planning on talking about. Yeah, macro environment is definitely very fluid, very mixed up, and definitely anything can happen coming down the road. So let's see. And like I've mentioned before, there's stuff, it's not an easy discussion, it's not an easy argument, because you've got all this stuff going on. You've got all these investments coming in from the Middle East, build outs, infrastructure, especially in AI, even in EVs. Then you have the AI industry that's launching, and it's going to do its thing in the future. So you've got the negatives and you've got the positives as well, right? Not easy to figure out which one is going to overpower the other, and it's probably going to be topsy-turvy. It's going to be up and down. But I think in a couple of years, even if something happens in the interim, maybe not even a couple of years, maybe even a year or so, we'll be okay. And we still have the interest rate levers, so not so hairy as some people tend to think. Okay, so now let's wrap it up with just a little fun thing that I did, because I was tracking all this stuff and following it for a long time. And I thought, let's take a look at all these prophets out there, right? People who keep talking about what's going to happen and what can happen, doomsday prophets, stock market legends and influencers who have a lot of media value. They have a lot of visibility out there, and they always tend to catch headlines. But just because they have their profile and this legend that's built around them, they, when they did what they did that made them famous, with the exception of Warren Buffett, of course, because he's been around for a very, very long time. These guys tend to be wrong a lot of the time, and that's at least definitely what I have found out to be true since I started investing, because Michael Burry of The Big Short fame. So I don't know if you guys have seen The Big Short, which definitely recommend that movie if you're into markets and financials and investments. That has to do with the 2008 mortgage crisis here in the USA, which I was actually thick and thin in the middle of that crisis, right in the eye of the storm in California, in the mortgage market, in banking when it happened, and it affected me in a really big way. So he comes out of that fame. So he basically did CDSs, I think, credit default swaps, which is just a way of making a bet against the mortgage bonds, and he won pretty big. But for the last couple of years, ever since I've started following all this stuff, he's been very pessimistic, very downbeat on the macro environment and the stock market, and has been, tweeting out stuff about basically, taking a short position on the market, I guess, so to speak. And it's been wrong. It's been, I think, consistently wrong for the last couple of years. Jamie Dimon of JP Morgan Chase is another guy who just consistently keeps talking about the stress scenarios, I guess, and the doomsday scenarios, and all these apocalyptic predictions. And someday these guys, I guess, they're going to turn out to be right. But I think just because you keep saying that, the sky's falling, or the sky's going to fall someday, yeah, it'll fall, it'll go back up or something. But one day they'll turn out to be right, and I guess they'll just renew their legends and their profiles. But so far, I think pretty safe to say that in the last couple of years, they've kind of been more on the wrong side of things, calling out how things are going to pan out. Especially over the next 6 months to 12 months is a pretty serious horizon when you're making predictions about if you're going to be wrong or right. You can't say something that happens 2 or 3 years after you say it's going to happen and say, yeah, well, okay, I called it or I predicted it. Sooner or later, it'll come around for you to claim it. Warren Buffett was really interesting, and like I mentioned, he always has good advice, and it was good advice, for you to be prepared to live with capital losses in your portfolio, unrealized capital losses, if you're gonna get into it at this point in time. But he himself was talked about a lot, especially last year, about his cash positions, right? So he had built up about a 325 billion cash position during that time. I think he was mostly selling out of his Apple and Bank of America positions, which he had held for a long time, and he's profited a lot from them. So I don't think he had sold out of stocks, or sold out enough to kind of go into a wait and see approach and wait out for a recession or some kind of a retraction to take place so that he can take advantage of it. He was probably looking to book his gains out of those big positions that he's held for a long time, and he thinks, okay, those have lived out their life cycle and their gains, and probably a good time to get out. And maybe that's why he built up that cash position, and maybe he was just sitting with it, waiting to see what's going to happen. And I think he eventually does go back into quite a few positions, but he was out there for a fairly long amount of time. I would say 6 months or so with these positions. So if the idea was to wait and see, that hasn't panned out for him as well. So I don't think he was right in this situation as well. And most of the people who turned out to be right, like this gentleman over here, Torsten Slok. So I think it's Apollo Management. And he's also now coming out and talking about how Trump could actually end up in a pretty strong position in about 6 months to a year's time with all this tariff negotiations and upheavals and upending and everything that's going on around the world today. He's also now talking up about how that could actually come out in his favor down the road. And also how I don't want to make any claims over here, but I talked about in a previous vlog as well, is that tariffs does not mean a one-to-one in terms of pricing levels at the retail level, right? So there's something called price elasticity of demand, right? Which is, if I got that right, which basically means that if you change the pricing of a product up to a certain point, how that's going to affect demand for that product. There are products and there are markets that are price elastic, and there are those that are price inelastic, which means inelastic means that if it's groceries, it's gas, it's things you have to do, you have to live off them. Whatever the price movements are going to be, you're going to have to live with it. You're still going to buy up what you usually do. You can, you can maneuver around and you can do less. You can carpool where you didn't before. You can drive more cautiously, not hit the gas so much and stuff. You can do things, but more or less you have to, these are essential products. But other stuff, autos, durables, which are not must-haves but are nice-to-haves, over there price elasticity works very differently. Manufacturers, if they are getting hit with tariffs, I should say importers, or the manufacturers behind those importers may not choose to pass those down to the consumer because they may lose net revenue. It's not, if the price goes up, the demand could shift substantially where you are in a net loss position, right? So they have to do something else. They have to look at their advertising expense, their research and development expense, their administrative expense, their staffing levels, distribution infrastructure, and figure out something leaner, sleeker, and protect your margins that way. So all these Trump tariffs, how it's going to pan out is going to work out, in the way it's going to work out. It's going to be very difficult to predict. And I'm kind of in that camp, more in that camp myself, with what Mr. Torsten Slock is saying. Let me pull that up, actually. I think it's called How Trump May Have Outsmarted Us All. Yeah. So that's out there as well. So some very interesting narratives, and if this turns out to be the case, that will definitely be very, very beneficial for us, and for our portfolio. My prediction at this point, just for the sake of making a prediction, is that we might see a second half, kind of a more cooler second half of 2025. Things will settle down. Interest rates may start to come down, and then maybe a bit of a more sharper pickup starting in 2026, and hopefully EVs kind of come back into the fray at that point as well, and AI gets the kind of traction that it's getting, and quantum computing also takes off in a more solid way, and good things happen. But hey, who knows? Let's see what happens. All right, folks, that's a wrap for now. Interesting things coming our way. Good fun with this. As the Chinese have a famous saying, may you live in interesting times. And we are definitely living in some very interesting times. So until next time, take care.